Today I will use some speed in order not to make these videos heavy. A statement of comprehensive incomes, or the income statement. It's one of the final books of accounts that is used to show or to portray the organization's performance. It is prepared after the preparation of the trial balance. So the information we use in preparation of the statement of comprehensive incomes, or the income statement, is got from the trial balance. So here is its format, and after going through this format for the last time today, you will do question 3 and submit it online. So with this, you begin with the title, just like any other book of account. So after the title, you'll have the sales. If there is any sales returns or the returns inwards, you subtract them in order to get the net sales. I think we've seen net sales returns or returns inwards when we were looking at, I think, the books of original entry. Yes, one of the journals is called the sales returns or sales sales returns or returns inwards journal. So after getting the net sales, we less the cost of sales. The cost of sales is like the cost of the inventory, the purchase cost, what it costed you during the process of sales. So from the net sales, you less the cost of sales, and the formula is you get the opening inventory or the opening stock. You add purchases. If there is any purchases returns, purchases returns are also called returns outwards. If it's there, you less it from the purchases, then you get the net purchases. So this net purchase is what you add on the opening inventory. So if there is any carriage inwards, you add it, such that you get the cost of goods available for sale. From the cost of goods available for sale, some books for college accounting, they call it just goods available for sale. So from goods available for sale, we less the closing inventory or the closing stock. This closing stock is always found in additional information provided. That's why we say before answering this question, always read all the transactions. So after lessing the closing inventory, what we get is the cost of sales that we have been looking for. By getting the opening stock, we add purchases, add carriage inwards, get the cost of goods available for sale, less closing stock. We were looking for the cost of sales. So the cost of sales will be put in the same line where there is net sales, as you can see in this video. So we'll get the net sales, as we had said here, net sales minus or less cost of sales. So this is our cost of sales. So we get the gross profit. So when we get net sales minus cost of sales, then we get gross profit. So what is the gross profit? This is the profit we get after getting the sales or the net sales, and we less the cost that was used, cost that was incurred during the selling exercise. It's the first profit, and we say in business, when you get this profit, don't be happy. If you bought matoke each at 10,000, maybe they were 10 matoke, you used 100,000. Then you sell each matoke at 15,000. By the end of it all, you have 150. So when you less 100, which was the cost of sale, and you remain with 50,000, don't celebrate that you have profit, because after getting the gross profit, you are supposed to go on as by this steps are showing. If you have any miscellaneous incomes, these are incomes you get unexpectedly. You receive them when you are not aware. For example, discount received. You go to purchase, they give you some discount back. It's the income you receive that you have not planned for. Maybe rent received. You are renting a store, but in the process, you sub-rent someone and you receive some rent. So it's an expected income. So when we get the gross profit, when we get the gross profit and add the miscellaneous income, gross profit, and then we add this miscellaneous income. Actually, this miscellaneous income should be here. Gross profit, you add the miscellaneous income. So yes, gross profit plus the miscellaneous income. So this is our total miscellaneous income. Gross profit plus miscellaneous income, it gives us the gross income. So this is the total income. Now, this total income, you're supposed to less the operating expenses. Less means subtraction. You're supposed to subtract the operating expenses. What are the operating expenses? These are expenses that you incur in the daily running of your business. They can be water, electricity, stationery, insurance, staff salaries. They can include ink. Okay, ink is in stationery. They can include house rent, etc. So when you sum up all the operating expenses, you get the total operating expenses. It is here. So when you get the gross income and subtract the total operating expenses, or you less the total operating expenses, the answer you get is called a net profit. So what is the net profit? It's this profit you get after you've got the gross income or the gross profit and you subtract the administrative or the operating expenses. I think class, you're seeing this. Members, I think you're seeing this. This is a format. It starts from up with the title, sales, net sales, cost of sales. You go on, get gross profit, miscellaneous incomes, operating expenses, until you go to net profit. It can be called net profit or net loss. So when you have a negative, you have a loss. When you deduct and you have a positive, that is a profit. So members, I'm going to post this video for you on your WhatsApp. If it accepts, I'll also put it on my YouTube channel. Follow up, and please don't fail to ask questions, because you're going to use this format to do question 3 of the work that I gave you. Members, I thank you, and please ask, because I know we are going through a time that is not easy for all of us. So the next thing we are going to look at is the second book, or the second final book of account, called the balance sheet or the statement of financial position.